I'm Steve Landers from Salt Financial Group. Join me today and Daniel Dubois, our Accounting Director, as we talk about the 2026 federal budget changes. All right, thanks for joining us today. I'm Steve and this is Daniel, and we're here to talk about the federal budget today and some questions that we've got for each other, and I guess our view of what we're seeing in the industry. So Daniel, we'll start with you. So you've obviously got a fair few business clients that you work with. What are you seeing that affecting these business clients most with the federal budget changes?
Coming out of the budget, probably the primary thing that I think is going to be important for client groups is going to be conducting a review and an examination of their structures. Everybody's circumstances are different. You might have companies, you might have a different variety of trusts, you might have corporate beneficiaries, whatever it might be, and understanding what the impact of the changes are going to be, both the trust changes and the CGT changes. That's going to have a variety of different impacts across everyone's client group. So working through that, working through modelling what the impact's going to be. Is your business in startup? Is your business a mature business? They're all going to have different impacts, and it's going to be pretty important to try and have a look at that and get an appreciation and understanding of what's going on.
Yep. And do you think, I guess, there's anything that you can see that clients should be considering to act on before these reforms go through?
I think it's pretty important to understand what your circumstances are before you act. There's going to be a variety of different actions that might take place, whether that's going to be transfer or disposal of assets, whether it's going to be a restructure of some of your entities. For example, a trust might consider whether or not it's appropriate to change over into a company to avoid some of the circumstances, or some of the unforeseen outcomes that may come out as associated with these trust changes.
Yep.
That's probably the main thing.
Yeah. Trusts probably, I guess, do seem to be the one that's maybe impacted most, like structure-wise, and I guess on the financial planning side, we're looking a bit at whether people should be retaining their trusts and maybe moving to different structures, even individual structures, I suppose, depending on protection. But how do you think they're likely to be impacted the most, the trusts?
Well, to start off with, there's going to be a tax of 30% on net trust income. So that then gets passed as a tax credit, similar to, but quite distinct and different from franking credits, and it will pass to the beneficiary of the trust where they are an individual. Where there's a company that's the beneficiary of the trust, they won't benefit from that tax credit. So understanding your own group structure, understanding what the income that's going to be coming through, and then what the tax outcomes are going to be is pretty important, because you could very easily, if you carry on with your existing structures the way they are at the moment, you could very easily end up being essentially double taxed, because you will pay 30% trust tax and a 30% tax in your company. A lot of what's happening, this is a fairly significant change. It's the biggest change in probably a good 20 years. And people have set up structures 10, 20, 30 years ago under a tax environment that was stable for all intents and purposes and didn't have these significant changes. So making sure you understand what's going to happen if you carry on the way that you are, compared to what might be able to happen if you appropriately restructure, is going to be important.
Yeah, the company one does seem like the biggest change there from some of our strategies, just that distributing to bucket companies that we've been able to do in the past, and I guess they've got 1 year left to do that, and then need to find another way to go down that path. And so you'd probably encourage clients then to come in and get a review sooner rather than later, just to check what we can do, I suppose, and potentially wind things up or restructure before the legislation comes through. Or you think that most people should be waiting till after it's all finalised?
We should wait for the final raft of what's going to go through for it to actually be enacted in Parliament. It's pretty important to wait and see what's actually happening. Also, the government did announce that there were going to be transitional provisions put in place to make it easier for, in particular, trusts to restructure into other entities. So that's not been released as yet. So watch this space but still get an understanding of what the impact of these changes are on your own circumstances.
Mm-hmm.
Steve, given this FY26 budget that's been released, what are clients actually asking you this year in relation to the way it impacts upon their planning and their wealth management?
Yep. Like I suppose the property's the main one. I guess a lot of people are invested in property in this country, and that's probably one of the bigger ones that people are worried about. It's not, it's not all doom and gloom, I suppose, in terms of what people do have in terms of how it's actually going to affect them. Like obviously the negative gearing benefits continue on, and that's not going to be an issue for them going forward. And look, CGT, we're probably in a period where we don't have a lot of expected growth anyway in the property market, and so for some people having that CPI discount from next year is probably better than the 50% in some cases. But there are a lot of questions around that. The other one was probably around testamentary trusts, when they see that there's sweeping changes across trusts and how that leads to changes to beneficiary taxes, and worried about that. We've obviously had some news lately that testamentary trusts aren't impacted by that, and that's, I guess, reassuring for clients that we don't need to worry about that, and we don't need to look at redoing wills at that point. But I think, at the moment it's just a uncertainty really, and I think that's sort of across the board, and you're sort of seeing a bit more in the economy and just the sentiment of what's going on, and just that uncertainty is leading to delays in spending and action, I suppose, until things are a bit more known.
Yep. So going back to the property aspects that you were touching on before, in terms of the way you're approaching the way we advise clients in relation to that, how are you balancing that off against overall client portfolios and everything else like that, and I suppose the separation of things like direct property compared to property trusts and whatever else?
Mm-hmm. Yep. So I guess they've always been a popular asset class in Australia, property, or direct property in particular. It's been becoming more and more difficult, I think. So even before this, there was really a lot of headwinds for property, and I guess if you look at the lifespan of the property, and starting from now, even you're buying something that has single asset risk, and people are putting a lot of money into that. So if that isn't rented out, if it's say a commercial property or something like that, and we're not getting rent off that asset because businesses aren't going well, that creates a lot of risk in a single asset. Most people are looking at residential, but so if we're buying a residential property, we've got some pretty big upfront costs in our stamp duties and conveyancing and all that kind of thing. So already we're, I guess, behind a lot of other asset classes that are fairly cheap to establish. In that journey of owning direct property, landlords have a lot less rights than they used to. There's a lot that they are now responsible for, and that adds a lot of expense to them as well. Land taxes, especially in Victoria, have gone up a huge amount, so those ongoing pressures escalating. If there is negative gearing on that, it always meant they were losing money, but at least there was a tax kickback for it, and that's no longer there, which is less attractive for people to be owning it. And then on the other side, if there is gains, you potentially have a lot less of a discount on what you pay on the capital side. So it doesn't really look attractive, especially in this market where we've got a lot of uncertainty in the property market. We've got a lot of potential risks around interest rate rises and other things that are going on. So I think people are definitely looking for other things. Property trust, I like from the point of view that it is just more diversified and it's more liquid. If you did need money quickly, it can be sold out in a week or so, whereas a property is, you can't be selling off a kitchen or something like that to fund something that comes up in an emergency. So that's an easier way, probably those property trusts. I think people that in the past have wanted that negative gearing benefit, that still exists, just not on property. So we do have some clients that are borrowing for a diversified managed fund portfolio, and that's still possible from a tax point of view. That hasn't been cut out at all. So I think from a negative gearing point of view, it does still exist, but it just changes the asset classes that people get into.
So just in finishing up on this budget section for you, Steve, are clients changing their investment behaviours too early based on media commentary?
Well, I don't think it's too early. I think there's always been I guess, challenges there with, you know, property, in particular in the last few years. So like it's probably not premature in terms of what they're looking at. I think it's right to probably question a bit more, because it has been a, you know, little bit of a myth in a way that property is always going to lead to higher wealth creation, and it has happened definitely for other generations. Looking at our property market here, we've, you know, things like apartments haven't moved in 10 years. We probably haven't had a lot of growth across the board, even in houses, in the last 5 years. So it's not always going to be that golden bullet for generating wealth. So I think it's just opened up a few more questions where people are considering what other options are out there, and even a, you know, simpler 5% term deposit is going to be doing a lot better than properties in a lot of cases now, where you know, losing money each year and not getting capital gains. Like that's not a good wealth creation strategy. So I think, you know, rather than sort of just blindly following what, you know, your parents might have done, I think just having that question and maybe speaking to someone about other options is probably a good idea at this point.
Well, I know one of our next segments is going to be exclusively on property, so we might pick up the property ball a little bit further along. But I suppose one of the things that really comes out of this is that people really do need to book in, well, either for a review of their asset portfolio in the context of what's changing, or certainly from my perspective, having a look at your group structure, in particular, trying to understand what the impact of the budget changes is going to be on the combination that is in your personal structure in relation to trading companies, trusts, whether they be unit trusts or discretionary trusts, and the difference, of course, between trading companies and corporate beneficiaries as well. So there's some fairly significant changes in that. We'll pick the next one up in the next segment. Thanks very much.
Thanks for watching. Come to our website for more information.